ARM Holdings has become one of the most strategically important companies in the semiconductor industry because its CPU architecture sits inside smartphones, cloud servers, networking equipment, automotive systems, and increasingly AI infrastructure. The investment thesis for 2026 and 2027 is changing rapidly. ARM is no longer simply a smartphone IP licensing company. Its data center royalty business is accelerating, while its new ARM AGI CPU could create an entirely new direct silicon revenue stream. The key question for investors is whether this new AI opportunity can justify ARM's very high valuation. ARM operates a fundamentally different business model from companies such as NVIDIA or AMD. It generally does not manufacture the chips used by customers. Instead, ARM develops CPU architectures and intellectual property that companies license and integrate into their own chips. ARM earns money through upfront licensing fees and royalties when chips based on its technology are shipped. This creates an attractive model because successful designs can generate recurring royalty revenue for years without ARM having to build and operate semiconductor fabrication plants. ARM entered fiscal 2027 from a position of significant strength. Fiscal 2026 revenue reached approximately $4.92 billion, representing 23% year-over-year growth. Net income increased 14% to approximately $904 million. Royalty revenue was approximately $2.61 billion, while licensing and other revenue contributed roughly $2.31 billion. Importantly, this represented ARM's third consecutive fiscal year of more than 20% revenue growth. The first quarter of fiscal 2027 showed that the momentum had continued. Revenue reached a record $1.29 billion, up 22% year-over-year. Royalty revenue increased 22% to $715 million, while licensing revenue increased 23% to $574 million. Non-GAAP EPS reached $0.45, up 29% year-over-year and above management's previous guidance. The most important fundamental development is ARM's rapidly expanding presence in data centers. Data center royalty revenue more than doubled year-over-year in the latest quarter. ARM's Neoverse platform has now surpassed approximately 1.5 billion cores shipped, with the latest 500 million cores being shipped in only 9 months. This is important because AI infrastructure requires enormous amounts of CPU capacity alongside GPUs, and hyperscalers increasingly want energy-efficient CPU architectures. The AI revolution does not only benefit GPUs. AI data centers also require CPUs for orchestration, networking, storage, inference, and increasingly agentic AI workloads. ARM believes the transition toward more autonomous AI workloads can significantly increase CPU requirements inside data centers. This creates an opportunity for ARM to capture more value as the number of ARM-based cores per server increases. Management has described a potential data center CPU opportunity exceeding $100 billion by 2030. The most aggressive part of ARM's strategy is its new ARM AGI CPU. Rather than only licensing CPU intellectual property, ARM is moving toward providing a complete production silicon product for AI data centers. This represents a major change in the business model. More importantly, customer demand for the AGI CPU has already exceeded $2 billion across fiscal 2027 and fiscal 2028, more than double the $1 billion opportunity ARM initially outlined. If ARM successfully converts this customer demand into actual shipments, the AGI CPU could become a major second growth engine. Management has previously outlined a long-term target of approximately $15 billion of AGI CPU revenue by fiscal 2031, alongside approximately $10 billion of IP revenue. The company has also outlined an overall fiscal 2031 revenue ambition of roughly $25 billion. ARM's biggest advantage is its ecosystem. Its architecture is already deeply embedded across mobile devices, cloud infrastructure, networking, automotive systems, and embedded computing. Companies including Apple, NVIDIA, Qualcomm, Amazon, and other major technology players use ARM-based technology in different parts of their product portfolios. This installed base makes it difficult for competitors to displace ARM quickly because software compatibility, developer ecosystems, and years of optimization matter enormously in CPU architecture. The smartphone market remains a major source of royalty revenue for ARM, but investors should not expect the same growth rate here as in data centers. Management has warned about smartphone royalty pressure, particularly as memory costs and smartphone market conditions affect device shipments and chip economics. Reuters reported that the company expects smartphone royalties to face pressure even while AI and data center demand remains strong. ARM's licensing business is another important piece of the model. Licensing revenue can fluctuate substantially from quarter to quarter because large agreements are not signed evenly throughout the year. Therefore, investors should focus not only on individual quarterly licensing revenue, but also on annualized contract value and the underlying number and quality of new design wins. ARM reported ACV growth of approximately 13% year over year, indicating that the underlying licensing business remains healthy. For my base case model, I estimate fiscal 2027 revenue at approximately $5.8 to $6.0 billion, representing roughly 18% to 22% growth. The main drivers would be continued data center royalty expansion, strong ARM v9 adoption, healthy licensing activity, and the beginning of the AGI CPU contribution. The biggest uncertainty is how quickly AGI CPU demand converts into recognized revenue, because the company is still expanding manufacturing capacity. For fiscal 2028, I estimate revenue could reach approximately $7.1 to $7.6 billion in the base case. This would represent another strong growth year if data center royalties continue compounding and the AGI CPU business begins scaling. In a more aggressive scenario, revenue could move above $8 billion if AI infrastructure spending remains extremely strong and ARM captures more of the custom CPU market. EPS growth could become even more important than revenue growth because ARM has significant operating leverage in its licensing and royalty model. My base case estimate is approximately $2.25 to $2.50 of adjusted EPS for fiscal 2027 and around $3.00 to $3.40 for fiscal 2028. These estimates assume continued investment in R&D, but also improving revenue productivity as the business scales. ARM's margins deserve close attention because the company is investing aggressively in future growth. R&D expenses have increased significantly as ARM develops new products, including its AGI CPU. That investment can temporarily pressure operating margins. But if revenue scales faster than operating expenses, the business could eventually generate substantial operating leverage. The long-term objective should therefore be viewed as balancing near-term R&D investment against much larger future revenue opportunities. One of ARM's biggest advantages is that it operates an asset-light intellectual property business compared with semiconductor manufacturers. It does not need to build enormous fabrication facilities to generate its traditional licensing and royalty revenue. This can support attractive cash generation as the company scales. The AGI CPU strategy changes the capital requirements somewhat because direct silicon introduces manufacturing and supply chain complexity, but ARM remains fundamentally different from a traditional semiconductor manufacturer. The bull case is straightforward. AI infrastructure spending continues growing. ARM captures a larger share of data center CPUs, Neoverse royalties accelerate, and the AGI CPU becomes a successful commercial product. If ARM can eventually approach its long-term $25 billion revenue ambition, the company's earnings power could be dramatically higher than today's levels. Under this scenario, the market could continue assigning ARM a premium multiple because investors would be valuing ARM as an AI infrastructure platform rather than simply a semiconductor IP company. My base case assumes ARM remains one of the major beneficiaries of AI infrastructure, but does not completely dominate the CPU market. Data center royalties continue growing rapidly, Smartphones remain relatively stable, licensing grows at a healthy rate, and the AGI CPU becomes a meaningful but gradually scaling business. Under this scenario, ARM delivers strong double-digit revenue growth through 2027 and 2028, but valuation remains the biggest limitation on stock returns. The bear case is mainly about valuation and execution, rather than the collapse of ARM's underlying business. If smartphone royalties weaken, data center growth slows, AGI CPU shipments are delayed, or competitors gain share, revenue growth could fall below expectations. At the same time, ARM currently trades at a very demanding valuation, meaning even a strong business can produce disappointing stock returns if the earnings growth does not keep pace with investor expectations. This is probably the biggest risk for investors. ARM is an exceptional business, but an exceptional business can still be an expensive stock. The market is already pricing in substantial future AI growth. Therefore, investors should not simply ask whether ARM will grow. They should ask whether ARM can grow faster than the valuation already assumes. That distinction is extremely important when analyzing ARM. The AGI CPU opportunity is exciting, but customer demand is not automatically the same thing as recognized revenue. ARM has acknowledged manufacturing capacity constraints around the initial opportunity. The company needs to secure wafers, memory, packaging, and testing capacity, and then successfully deliver production systems to customers. If execution takes longer than expected, investors may have to wait longer for the revenue opportunity to appear in financial statements. Smartphones still matter. If global smartphone demand weakens significantly or customers shift toward lower value chips, ARM's royalty growth could slow. This is particularly important because the smartphone business remains a large part of the company's existing royalty base. The good news is that data center growth is increasingly providing a second major source of royalty expansion. ARM faces competition from x86 architectures, RISC-V, and internally developed CPU architectures. RISC-V is particularly interesting because it provides an open instruction set alternative. ARM's defense is its mature ecosystem, performance, software compatibility, and enormous installed base. But investors should continue monitoring whether customers increasingly develop proprietary or alternative architectures. For my DCF framework, I would use a long-term revenue growth trajectory that gradually declines from high teens or low 20s growth toward a mature semiconductor IP growth rate, while assuming strong free cash flow conversion. Because ARM is still investing heavily in future products, I would avoid using an overly aggressive near-term margin assumption. The resulting valuation depends heavily on the terminal growth rate and discount rate, which means the DCF should be viewed as a range rather than a single precise number. My estimated 2027 valuation framework is approximately $180 to $220 in the bear case, $250 to $300 in the base case, and $330 to $400 plus in the bull case. The extreme bull case requires ARM to successfully scale its AGI CPU, maintain rapid data center royalty growth, and eventually approach its ambitious long-term revenue targets. These are scenario-based estimates, not guaranteed future prices. My bull case 2027 target is approximately $350 to $400. To justify this range, ARM would need continued 20% plus revenue growth, rapidly expanding data center royalties, strong AGI CPU adoption, and significant operating leverage. If investors begin valuing ARM closer to an AI infrastructure platform than a traditional semiconductor IP company, the premium multiple could remain elevated. My base case 2027 target is approximately $275 to $325. This assumes ARM continues to deliver strong growth, but valuation gradually normalizes. In this scenario, the company remains an excellent long-term business, but investors receive more moderate stock returns because a portion of the future growth is already reflected in the share price. My bear case 2027 target is approximately $180 to $220. This scenario assumes slower data center adoption, weaker smartphone royalties, slower AGI CPU commercialization, and multiple compression. Notice that even this bear case does not require ARM to become a bad company. It only requires growth to disappoint relative to an extremely optimistic valuation. Putting everything together, my framework is bear case, $180 to $220. Base case, $275 to $325. Bull case, $350 to $400. Extreme bull case, $400 plus. The most important variable is not simply revenue growth. It is the relationship between ARM's future earnings growth and the valuation investors are willing to pay for those earnings. ARM is different from NVIDIA and AMD because its historical business model is based primarily on intellectual property rather than manufacturing chips. NVIDIA has enormous exposure to AI accelerators, while AMD competes across CPUs and GPUs. ARM potentially benefits from both sides of the AI infrastructure equation because its architecture can be used in CPUs that sit alongside accelerators. This makes ARM an interesting indirect beneficiary of the AI build-out. Fiscal 2027 and fiscal 2028 could become particularly important because this is when ARM's AGI CPU opportunity begins moving from customer commitments toward actual commercial deployments. At the same time, the traditional royalty business continues benefiting from data center adoption. If both businesses accelerate simultaneously, ARM's financial profile could change substantially over the next 2 years. There are 5 numbers I would monitor every quarter: total revenue growth, royalty revenue growth, data center royalty growth, AGI CPU customer demand, and adjusted EPS growth. I would also monitor operating expenses because ARM's ability to convert revenue growth into earnings growth will determine whether the current valuation becomes easier to justify. The fundamental thesis for ARM is becoming stronger. Fiscal 2026 delivered 23% revenue growth. Quarter 1 fiscal 2027 delivered another 22% increase. Data center royalties are growing extremely rapidly, and AGI CPU demand has already exceeded $2 billion for fiscal 2027 and 2028. My final rating for ARM is hold, buy on significant weakness. I consider ARM one of the highest quality long-term semiconductor architecture businesses, and its AI and data center opportunity is genuinely compelling. However, the valuation creates a large margin of safety problem. For investors who already own ARM, the fundamentals support holding through volatility. For new investors, I would prefer buying during significant corrections rather than chasing the stock after major AI-driven rallies. So, can ARM reach $400 by 2027? Yes, but it is not my base case. A move toward $400 would require ARM to execute exceptionally well on data centers and the AGI CPU while maintaining strong licensing and royalty growth. My base case range is $275 to $325. My bull case is $350 to $400, and the extreme bull case is above $400. The biggest opportunity is AI infrastructure. The biggest danger is paying too much for that opportunity. ARM is no longer just the company behind smartphone CPUs. It is becoming a critical architecture provider for the next generation of AI data centers, cloud computing, networking, and edge devices. The next 2 years could determine whether ARM successfully transforms from a high-quality semiconductor IP company into a much larger AI infrastructure platform. For investors, that makes ARM one of the most interesting and valuation-sensitive semiconductor stocks to watch through 2026 and 2027.